right? Okay. Also very important for a non-tax resident of Australia. I would say most bonds are being exempted. The issuer are exempted to withhold tax for non-tax residents. Okay, non-tax resident doesn't just mean that they are foreign, alien. What I mean that, or even for Australia, right? They're working overseas. They're expat in Hong Kong, Singapore, UK. As long as you are not considered as a non-tax resident of Australia, the issuer will not withhold the non-resident withhold tax. The reason being is that under the Income Tax Act, Section 128, there's something called public test. Because most of the bonds are, as an individual, you need to have a custodian to actually help you hold it. It's a bit like a trade sponsorship when you trade shares. But trade sponsorship, as an issuer, you'll be able to look through who's the that security. But for bonds, basically, the issuer cannot. The issuer will only see the custodians are either Citibank, HSBC, JP Morgan, all the big banks. They will act as a custodian, so they can't look through. So they don't know who is tax resident, who's not. So that is why that compared to other form of investment that will pay you interest, typically as a non-tax resident you get 10% withholding tax, but for those they are exempt. Remember, the Tax Act for the withholding tax is the obligation of the issuer. So for the investor, we are not saying that you don't pay tax, right? We are saying that depending on which jurisdictions that you must report your tax to, you have that obligation and responsibility. Okay, so but this is something that quite technical that people often ask about. Okay, so we will also give you another example. So this is a fixed. We want to show you a US dollar bond because we obviously being a bond broker, we can actually trade bonds that denominated in all sort of different currencies, right? So so this one was issued last year. So for Tier 2 bond, that Barclays, probably the second or the third biggest bank in the UK, they will pay a fixed coupon of 7.119 for 10 years. And then if they don't call, it becomes a floating. They use a SOFR. You can consider that like a US cash rate. It's actually like it's the new benchmark, right? In the old days, we all use LIBOR, but now you're going to SOFR. And they use that benchmark plus 3.57%. So that gives you a sense, because something like this, when it was issued last year, I think we all probably are aware that FOMC started cutting interest rates last week. You'll be amazed that this bond is trading well above $110. Okay, so some investors that got into last year before that kind of a rate cut, or kind of that in terms of that anticipation start to play out or price in the market. Some of the investors start already position themselves for fixing their coupon for the longer tenor, and then they start to see the benefit of it. Okay. Same thing. I think for us, HSBC US dollar bonds are also very popular bonds that we our clients like to acquire. Apart from US dollars or offshore issuers, we also do GBP. Actually, we do have there's a community of financial advisors that do assist a lot of UK immigrants with client coming over from UK with British pounds. Out there's really not much solution to offer them. So we do provide solutions that where a client looking to invest in British pounds. So we have clients coming to us with British pounds, euro, New Zealand dollars, Hong Kong dollars, Singapore dollars. So I think this is probably one of the strong benefit or advantage when we are dealing in the bond space, because cross jurisdictions and markets, it's something that we do pretty much every day. Okay, right. So we talked about Tier 2. Now we wanted to talk about additional Tier 1. So what are bank capital notes? So this is the term that we use in Australia. Capital notes are considered a hybrid security that they share the characteristics of being a debt and equity at the same time. So why we call it a hybrid, because on one hand, they are issued at $100 face value, and they have fixed call dates that where the issuer have the right to call them back, i.e., pay them back or buy them off, back from the investors. So and then they also do have periodic payment in terms of distribution. Okay, now so that make them look like a bond. Okay, but the nature or the legality of the capital notes is more akin to equity. Why? Because the distribution you get from capital notes are not considered as interest. They actually considered as a dividend. Okay, and they share the same dividend policy as you will invest in their common shares. So, i.e., if you buy into a CBA shares, or you buy into capital notes issued by CPA, you have the same franking amount. So CBA is 100% franked, but NZ is only about 46% franked, right, or 40% franked. So the franking level has to be the same, because the income that the bank used to pay distribution for capital notes are considered as the dividends. And the reason being is that if you buy into a bond, your coupon payment is cumulative. That means they are part of the debt obligation. If you buy into a bond, okay, and the bank say, I'm going to pay you 6%. If I say I missed the coupon payment this time, that I'm in technical default, because next time I will have to pay you whatever I owe you from the last coupon payment I missed. But if you are treated as a dividend, you don't have to. Let's just say that, I'm a bank, I'm not doing so well this year. I've already come out of the market and give some kind of negative, profit, warning guidance. I'm going to cancel my dividend for the rest of the year. This will apply to capital notes as well. So the distribution coming out from capital notes are not cumulative. Okay, so that's what makes them as like equity. Also, when the bank is in distress, they also have a mechanism to be exchanged or converted to equity. Okay, but you're obviously not converting at $100. You're converting at the time that where the regulator deemed the bank are non-viable, right? So you imagine if the bank goes through that scenario, you'll be buying up their shares at a very, very, I guess, low valuation.
Isn't that the reason why they're talking about getting rid of hybrids now?
Yes. Did we leak our presentation? There's a mole. Yes. That's the reason why we invite everyone into. We want to talk about the announcement from APRA. Actually, I guess since you're on that topic, I think we may just go straight into it. It's probably reconnaissance of time. Come back. Okay. On the 10th of September, which is 2 weeks ago, APRA came out, issued a discussion paper. And in fact, before the discussion paper, they've already been consulting with all the stakeholders in the market about their proposal to change the capital framework of the bank. They are proposing, okay, nothing has been legislated or finalized. They're proposing to get rid of the tier 1, i.e. the capitals. It's been obviously a very popular instrument for retail investors, and I think that's what APRA's worry about. And in fact, started 2-3 years ago, that only restricted to the wholesale investors that are allowed to participate in any new issuance and IPO. Okay, but they don't think it's enough. They want to get rid of it completely. Obviously, there are many reasons behind it. What happened to Credit Suisse last year, that being forced to acquire by UBS, potentially was a precedent that where RBA kind of, I would say that what actually happened in Switzerland was there is now a class action going on. There's a lot of investors actually suing the Swiss National Bank and the regulator. Yeah. So anyway, So I think that when the proposal came out, I don't think that we are surprised. However, there is there's a sense that a growing amount of market participants that are putting their interest ahead of the markets and investors. They worry that they're being sued. They worry that people got into the wrong the instrument without understanding the risk. But having said that, it's a $44 billion market in all the hybrids. There's a lot of brokers participated. There are a lot of investors that have a number of different gang hybrids in their portfolio. So if APRA's going to phase it out, you know, it's like who moved my cheese, right? It's like it's a big market. It's and also quite lucrative as well. Okay.